All right, we're live. I'm guessing sound and camera are good, so I'm just going to proceed. This is AMA number 24. Now it is official. We've been doing this for 2 years. Most of you were probably not around at the time, but those of you who were, Perry and a bunch of others, I know that you're out there and still joining. So thanks for being around for all this time. We're going to keep doing this for as long as I'm able. All right, so let's dive right into it because yes, I think the elephant in the room is what the hell is going on in crypto. It's a good thing, I guess, for most of us because I think even me, who I've changed my strategies lately, where I'm mostly trading crypto through algorithms, at least the new positions, but I still hold exposure at all times. There are things I never sell, so I'm glad to see this. No, I didn't load up. I didn't back up the truck really. I did not buy, just full disclosure, what I did. I never actually bought this low. Yeah, we saw it coming. We did discuss it. It was not surprising at all when it did happen. Um, but the issue is, I didn't think it would amount to much, to be honest, because it was just like this rally here, at least pair Japanese M2, which is what you see here. This rally was supposed to be, or was likely to be, just as weak as the February through early May rally. So I never bothered, and it was probably because as the 4 year cycle unfolds, volatility tends to go down. And so I thought if this February, May rally was weak, this June to August rally is going to be even worse. And I say August, even though Japanese liquidity said this probably would end in late July, July 31st to August 1st at the latest. I think the planetary model said around August 7. Here we are making new highs on August 21st. So the first elephant in the room that needs to be addressed is, did the model catch this? No, not really. Unless, like you said, Perry, and I did think about this, what if we just move Japanese liquidity? That's kind of a dirty trick. I don't think that's what it is, really. I do think it might fit. Oh, come on, to do some loading. It, yeah, you can see that it doesn't really. We need to move it like another, I don't know, 105 days. There we go. I think that's the most I'm willing to do. It doesn't really fit. Sure, we could do this, but the reality is, and this happens before I proceed, I move forward on that. Let me show you last time it happened. This happens. There are deviations between Japanese liquidity, and this is, by the way, for those of you who are on YouTube watching the replay, this happens. Yes, Japanese liquidity or these liquidity indicators are like having a crystal ball that tells you what Bitcoin's going to do, but they're not infallible. That's why I always say they're not GPS coordinates. They're just like a roadmap of what's going to happen. They give you a very, very solid idea of what is likely to happen with crypto over the next 3 months, but there are deviations. Most notably, the most notable deviation that I remember prior to this one, which is incredible, um, is here in October. Notice that Japanese liquidity, Japanese M2, and Bitcoin was largely following it at the time. We were not mostly using Japanese M2 at this time. We were using central bank liquidity, but they were very closely aligned. So whether you looked at the balance sheets of central banks in dollars, or whether you use a or whether you looked at Japanese M2 back in 2025, it didn't really make a difference. So I'm not going to bring up that chart. Suffice to say, it's pretty much the same. And notice that Japanese M2 showed a top on not August, July 14, and then a secondary top in early August. And then what it said is you might get a rally in September, I think. And we did get a rally in September. It's this rally here. So we did get this rally in September. But then from there, it started to decline. And it started to decline significantly. Initially, it didn't look like much, but then, of course, it took a nosedive. So Japanese M2 was early in warning that Bitcoin was going to enter a bear market. But for a few days in there, that's not what it looked like. If you just look at, and there's a tool in TradingView, but I don't remember how to pull it up. If you just look at this section here, notice that on October 6th, this is the October 6th high. On October 6th, um, Bitcoin was making new highs, and it was moving in the exact opposite direction as Japanese M2 and also central bank liquidity, which is why I was considering other liquidity metrics which showed the breakout. But in the end, they just lined up. Bitcoin just lined up perfectly with Japanese M2 and central bank liquidity at the time. I mean, I think I have it here. Maybe I can show you so I can start talking about it and actually show it to you. There we go. So you can see that, yeah, they're aligned. Blue is central bank liquidity. You can see how it lined up with Japanese M2. And neither of these projected a breakout to all-time highs. That is the current Bitcoin all-time high as of this recording in October. Nothing projected that. People call it Uptober. So I guess people were buying in anticipation of what they thought was going to be a bullish October. It was not a bullish October. Actually, I think that's very relevant to what's happening today, but we'll get to that in a second. Expectations. I think this can explain this explosive move. It's just expectations. So without further ado, sorry. Delete all this. There we go. So what happened is lately, or rather recently, what's been happening is something that we have seen before. There's another even more significant deviation from liquidity, broadly speaking, but this one is different. This one's different. This deviation can be explained by the ETF approval. So the deviation between October 2023, you can see how liquidity, and this is back in 2023, M2, global M2, Japanese M2, central bank liquidity, they all look the same, so you can use anything you want. And they all show the same thing. They show this decline starting in early October, and this decline would end with a low in early February of 2024. And Bitcoin went the exact opposite direction. I've shown this cross before, where you can see how they're moving in exact opposite directions. That's not what we're seeing right now. I want to make that case. This is triggered by an outlier event, ETF approval. So people are buying in anticipation of the ETF getting approved. That is a genuine drift from liquidity that we can explain. What happened in October, I don't think we can explain. I don't know what happened in October. I remember the market breaking out. I remember the new all-time highs. I remember even buying calls at 130, I think it was, November expiration. Very cheap calls, November expiry, because I didn't really anticipate this breakout because it didn't show up anywhere. I think even if you looked at other liquidity metrics, this exact breakout pattern in October, I didn't have it. I didn't see it. But you have to respect the move. So, of course, I wanted to get some exposure. Regardless, it was a rally. There were no news. It broke to the all-time highs. People kept saying, don't worry, Bitcoin will break in October because October is very bullish. It did break out in October, but it topped out on October 6th. I still have it flagged here. And then it went straight down. Well, not really straight down, but the bear market started, technically speaking, with the top of the 4-year cycle in Bitcoin, and that is October 6th. So that's what happened. That's what we're seeing here. Liquidity did not pick it up. You fast forward to the present, and I believe there's a little bit of the same going on here where, okay, the deviation, I think we've explained. The main takeaway here is Bitcoin can deviate from liquidity, but unless unless there's some major catalyst that nobody's aware of, this is likely a short-term move. The only time that I can remember Bitcoin deviating significantly for months, I'm talking 3 months, Bitcoin going up, liquidity going in the exact opposite direction, that's because of the ETF effect, let's call it. So SEC rumored to be approving the ETF because it was listed on the DTCC's website or something like that. Then it was confirmed that the SEC had indeed approved a bunch of ETFs. And then on January 9, the ETF started trading. And that's actually when liquidity lines up again with Bitcoin. So the bullish catalyst ends literally on the day that, and I'm going to show you that because I should just talk about it. The bullish catalyst literally ends here. The alignment with liquidity took place. I think this is better shown on central bank liquidity. So let me bring that up. There we go. So you can see how Bitcoin lines up with central bank liquidity exactly on the day that the ETF is approved, which was, I think the first day of trading was January 9. I thought it was January 9, not the 8th, but whatever. You can see how they're lining up exactly on this week, at least. So ETF, so people start buying in anticipation of the ETF. That allows Bitcoin to ignore what liquidity is doing. And the very day that the ETF, or the same week that the ETF starts trading, they line up again. So you can't make this stuff up. This was a known catalyst for the market. We knew why this was happening. We knew to ignore liquidity at this time. Um, but right now, bringing up Japanese M2 again, there's no catalyst other than this announcement by the Treasury that they're doubling their bond buyback operations. From what I know, they haven't actually bought any bonds yet. They just said that every operation is going to be 4 billion, whereas it used to be 2 billion. And yes, they've been doing a ton of T-bill issuance. I actually have a T-bill indicator here, which I haven't updated in months. Yeah, there we go. Treasury bills outstanding. So this is literally something that we know can act as a catalyst for Bitcoin. But from my understanding is no issuance has actually taken place. It doesn't really matter what the Treasury does with the T-bills, by the way, whether they're doing buybacks or financing deficits. It doesn't really seem to matter. The only thing that matters is whether or not they issue those T-bills. Those T-bills are cash equivalent, and this is why we call it Treasury QE, because it's the Treasury printing money. They're doing the printing through the banking system. If they want me to elaborate on that, we can, but I think it's a bit of a detour. So that was the spark, I guess, that triggered the rally. But why did it go up so much? Because honestly, I find it a little shocking. Why did it go up so much? I think it's the same thing as the October effect, expectations. Why were people buying in early October absent any catalysts? Because it's not as impressive as this rally, but it was a pretty impressive rally that we had in early October. It was pretty impressive. So this was a genuinely impressive rally. Um, no catalyst, and it was totally out of the blue. And Bitcoin went up like just it's October started, Bitcoin price starts heading higher. Why? Nobody knew. I asked around, just like now, I asked around, like, why is it going up? Nobody seemed to have an answer. Now we do have kind of an answer, but that's not a satisfactory answer. You know what the effect was on the treasury market? Like the place where the intervention is taking place? Let me show you. This is the 10-year yield. This is the day of the intervention, supposedly. Again, I don't know if there was an intervention or not, but it was not a lot. That's what I do know. It took place on this day. You saw rates come down, and the next day they were retraced, and now we're testing recent highs again on treasury yield. So it had no effect on the treasury market. So why did it have an effect on Bitcoin? My answer, I don't claim that this is the answer, but my answer has to do with expectations again. People were buying in October because October and bull market. Okay, these are memes. Now, I think what happened is this is a long way of saying this trade just got crowded. People were too short. I do know, and I didn't check. I haven't checked this in at least a month. But funding rates on perpetual on crypto perpetuals were had broke records for their longest stretch of negative funding rates ever, I think. So never had we seen in this market this concentration of shorts. Now, why did we have the concentration of shorts? I think it's because too many people, and this will come off as a little weird, but I think too many people were banking on the crypto cycle, right? And I don't mean us cycle analysts. I apply cycle analysis to everything. So I'm excluding myself, but I do know of a lot of people who talk about the crypto cycle without really having any understanding of how cycles work. They just talk about Bitcoin's cycle specifically because the Bitcoin cycles in general, unlike most markets, are extremely regular. How regular are they? Well, every single bear market in the past, give or take a month or so, has lasted about 12 months. Every single one of them is about a year long. And that is extremely regular. No, I haven't really seen this in other markets. But the Bitcoin cycles, up until recently, have been so regular and so predictable that this is my theory, my explanation, is a lot of non-cycle analysts started picking up on it and started talking about it. I'm talking about like influencers. Like I don't know, I don't follow a lot of these people, but I know Raoul Pal talks a lot about crypto cycles. And I met a bunch of I met this fund manager once. He has a hedge fund and he trades the Bitcoin cycle. And I interviewed the guy. I asked him if he applies the same framework elsewhere. He didn't really answer, but it was clear that no, he only looks at the crypto cycle. There's a bunch of people who talk about the Bitcoin's 4 year cycle. This is not Raul Pal. I would exclude him from that. He does talk about the liquidity cycle and whatever. Um, but they talk about crypto being cyclical as if that's unique to crypto. Now, why is that? It's because the cycle has been so regular. With the exception of the first bull market from 2010 that topped out in like 2011, we can exclude that one because it was a extremely liquid asset. But accepting that one, um, every cycle in crypto topped out in Q4, bottomed out in Q4 of the next year. So it's about 12 months in duration. It's always Q4. It was Q4 this time too. It was Q4. It was in October. A little early, but it was still Q4, right? I mean, October, November, yeah, it's a Q4. So as soon as Q4 started, boom, we have the top. So that's how regular it is. Not only that, I mean, even if you look at liquidity, we do see a low in October. This is about 12 months. This October low is about 12 months from the top. So yeah, a lot of people have picked up on the fact that Bitcoin is extremely cyclical. And this is just speculation. This is just me speculating. But I will say that cycles are not that easy. And if they are that easy, and most people notice, the cycle will probably shift in order so that most people get it wrong. Because I think if there's one thing that's more true than cycles in markets is that most people just get it wrong. The vast majority, I mean, 90% of people just get the markets wrong. So if everybody is shorting because we're in a bear market and the low is in October, we're not going to get it. We're not going to get a low in October. We're going to get a low somewhere else, some other time, some other price. If everybody's expecting 80% drawdown from the top, which I believe projected down to about 30K, slightly below that, then we're not going to get 30K because the trade gets crowded and it's a self-fulfilling prophecy in reverse. If everybody expects one thing to happen in a market, that will not happen. And so, how do you reconcile cycle theory with the fact that everybody's expecting the cycle to play out the exact same way? Well, these two things are not actual contradictions. Everybody's expecting the cycle to play out the same way. And that's what's not going to happen. The cycle will still play out. It will just fool most people. For instance, it will make a low, which I think took place. It will make its bear market low in July when nobody expected it, or very few of us were expecting the low to be in July. Now, you know that I was expecting the low to be in July because it it showed up on my forecasting model. It showed up on liquidity. It was this double bottom. And also, as of the past few weeks prior to this breakout, Bitcoin was trading extremely close to this critical trend line. And this line is a 320-day cycle VTL. If you don't know what that is, just go check out my YouTube lessons. But basically, suffice to say, if this green line is crossed, that means the last low that was left behind is a 4 year cycle low. And when we got close in late July, and I've said this many, many times, I'm on the record saying this, when the market gets close to these VTLs, it eventually crosses above or below, as the case may be. So the fact that Bitcoin was so close to this VTL told me that we're probably gonna cross. We're probably gonna cross at some point. Now, I didn't think it would explode in this fashion. I'll get to that in a second. But I did think it had enough going for it that it would cross above. Now, did I get it exactly right? No. I thought the crossover had to happen. I need to delete some of these arrows. I thought the crossover would happen as it topped out here sometime in late July. We did get a late July top. It was a little early on July 21st. Notice that Japanese M2 has this kind of a double top here. July, I think this is the 23rd. Okay, 23rd. I was gonna say 25th, and then the 29th of July. So we got it a little early, still pretty well aligned. What did not show up in liquidity is this. That's because this is a short squeeze. I'll get to that in a second. That doesn't show up in liquidity. But you're never going to see a short squeeze in liquidity. You have to explain it with some other, yeah, you need another theory to explain what happened over the last, or this week, or the past 3 days, mostly. You need another theory. I have one. I think you know what that is. So most people were expecting the cycle to end 12 months following the top. Nope. That doesn't, I mean, there's no, Hearst never wrote about that. If you watch my trading, in my cycle lessons on YouTube, I never say I actually emphasize something called the principle of variation, which is that cycles vary a lot. Now, most of the variation takes place in the cycle amplitude. In other words, how much does the price move up and then back down during the cycle? That's most of the variation. Some of the variation, though, is that cycles, if there's an 80-day cycle, for instance, that doesn't mean that every single cycle low is 80 days apart. In fact, for the most part, what that means is just an average. The average is every 80 days. It's all over the map. To be honest, that 80-day cycle on Bitcoin is anywhere between 40 days and 120 days. Yeah, it's a lot of variation. In fact, I do remember on that lesson saying, expect these cycles to vary by up to 50% of their ideal duration. 50% is a lot. It means a 4-year cycle can be anywhere between 2 years and six. Now, in Bitcoin, it's been 4 years, pretty much, give and take a few months, every single time. That's the exception. That's not the norm. This exception is why a lot of people think they know the crypto cycle. They don't, because we could see in the future 2-year long 4-year cycles, or 3-year long 4-year cycles, or 6-year long 4-year cycles. We could see this, and our framework here would still hold up. It would still work pretty well, because what we're looking for to confirm the 4-year cycle low is stuff like this: VTL crossovers, some cycle analysis. We face the 80-day cycle. We face the 320-day cycle. We do all this analysis because we know that cycles are just not that easy. They're not regular. It doesn't happen like clockwork. Otherwise, most people would know about them. Most people don't know that there's a 4-year cycle in the stock market, for instance. Most people don't know that. And yet, there it is. You can find that if you do spectral analysis like Hearst used to do, and I have done this, you're going to find a 4-year cycle in the stock market too. It doesn't show up sometimes, especially in the last decade or so. It's been like muted. It used to be a lot more regular in the past, but it's still there. And there is a 4-year cycle in, I would say, most markets. Not all of them. I don't think gold has it. In gold, it's clear it's 3.5 years, but that's close to Bitcoin's 4-year cycle. So this 4-year frequency, give or take a year or so, very regular. It happens across most asset classes. It's not unique to crypto. The reason people think it's unique to crypto is, like I said, it is so obvious in Bitcoin that most people just pick up on it. They notice that there's a cycle. But the cycles are not usually that easy to find. But that doesn't mean they're not there. If you use the proper tools, you're going to find it. I use the same tools to isolate Bitcoin cycles and confirm there's a 4-year cycle as I use on gold, to confirm there's a 7-year cycle and a 14-year cycle. That most people don't know about. Most people don't know there's a 7-year cycle in gold or a 3.5-year cycle. And people outside of this niche cycle analysis community, they don't think there are cycles at all. They think markets are random. Now, I know that's changing lately. I know that most people don't think the markets are random anymore. Or at least Claude said that to me. We used to be in the paradigm of random walk. Now apparently it's more about reflexivity and whatever. Fine, but I don't think cycles driving markets is how most people see it. And no, I don't think that's why they work. I think even if you convinced everybody that everything is cyclical, which you'll never do, because then everybody was going to start believing in planets and orbits and what have you, and most people think that's voodoo. So I don't think we're going to see people believe that there are cycles in our lifetimes. But even if they did, I don't think it's going to change. Even if everybody said, "Oh yeah, there's definitely a cycle to all this stuff," I don't think the cycle will change. I don't think the cycle is going to change, even if everybody starts trading with algorithms and robots, because those algorithms or robots are programmed by humans, and humans think cyclically, even though they don't really realize it. Anyways, long way of saying the cycles are always there. They never change, but no, they're not so easy to pick. They're not so easy to pinpoint. It's not so easy to say, oh, it's 12 months, boom, that's the low. That's not really how it works. Now, in Bitcoin, to Bitcoin's credit, and this is why Bitcoin has been great for me, yeah, it is pretty regular. So you can use these tools, count some time, and then go, yeah, there's the low in October. Except Bitcoin's changing, guys. It's different now. It's more professional. It's less volatile than before. For instance, one of the things that changed, and this was amazing because most people didn't notice. Typically, there are some, let me put it this way, because this is supposed to be a lesson for you guys to learn. At least my methods, right? I'm not all knowing. I don't know everything, but I have learned a few things using the cycle framework. And that is, there's a lot of, and if you read Hurst, I think he would agree with this. There's some recency bias to the way cycles unfold. Recency bias meaning that cycles tend to behave most, if you want to know what the next cycle is going to do, look at the last cycle. That's going to be the closest analog you can find. There's some recency bias there where the cycle tends to unfold in roughly the same manner from a time perspective. I'm not talking about price, I'm talking about time. From a time perspective, they tend to behave roughly the same way, or they tend to align with the recent cycles. That's why it's called recency bias. And one of the things that I noticed, and I was pretty convinced that this was going to happen because you could see it play out literally in real time, take you back to 2025. And notice that 2025, let me hide liquidity. We don't need liquidity for this. Takes forever to load on this not so great internet, but we don't need it. This is 2025. And what you notice about 2025 is there are two important tops, one here and another one here. These are 320-day cycle tops. There we go. Perry, that's awesome. Oh no, that's ES. Oh, that's good stuff, guys. That's good stuff. Keep posting that stuff. So 2025, the way I looked at it as a cycles analyst is there are two prominent 4-year cycle tops. Sorry, 320-day cycle tops in 2025. And this is different. This is not the way the bull markets used to unfold. Or rather, actually, it didn't unfold that way in 2017. That's the right way to say it. 2017, we didn't see this, but we have this between these two peaks, right? And this peak in October, it's a triple top. You know, the market topped out at about 120, 125. 3 times we have this test. The one in July, one in August, the final one in October. And then we have this double top. By the way, never had that before. Double tops on an 80-day cycle, never before. There used to be a 90% probability that you would make at least 50% return if you bought an 80-day cycle breakout. Lo and behold, 2025 comes around and these breakouts just start failing across the board. If you follow my work at Weiss, this is why I changed the strategy, because I had to change the strategy at Weiss. We used to just buy 80-day cycle breakouts. 90% probability we make money. Literally. I mean, you could not make this was like, oh, this is like it's shooting fish in a barrel, as they say. So easy. But then it changed. Then we started having double tops. Then these 80-day cycle breakouts stopped being so predictable. I no longer trade those breakouts at all. I trade around the 5 and 20-day cycles now. I didn't even have a 5-day cycle back in the day. Now I do. So we have a double top. 2 320-day cycle tops, big 320-day cycle correction in the middle. When did we see this before? Keep in mind, this is the last year of a 4-year cycle. We saw this in 2021, exactly the same. Not exact. Sometimes I say exactly the same and people go, well, no, it's not exactly the same. No, I know, but from a cycle perspective, from a timing perspective, yeah, it's pretty much the same. It's not the same in terms of the price moves, but it's the same in terms of the shape of the cycle. Look at this. This is 2021. We have 2 prominent 320-day cycle tops, one in April, another one in November. Both of these could be said to be double tops, with the first top being in March and the first top being, I think, in October. So we have a double top, 2 prominent 320-day cycle highs, and a big 320 correction in the middle. Am I talking price here? No, this is a 50% crash. Whereas what we had in 2025 is, I think it was 25%. I think, yeah, and it was 30%. How can we explain that? Well, the volatility of Bitcoin prices has been diminishing over time, but ever since institutions, like ever since the ETF came in and institutions started getting involved in Bitcoin, that volatility has come crashing down. So we can explain that away easily. Why did it not crash 50% in 2025? Institutional money and the fact that the market is more mature. But the shape of the cycle is the same, right? We have Q1 top, big 320 correction in the middle, and then we have the Q4 actual 4-year cycle top. It's exactly the same that happened in 2021 and 2025. Yet still, in 2025, most people were calling for a parabolic bull run as we end the year 2025. Where does the evidence come from for that? When did that happen? Well, it did happen. It used to happen. It used to happen, happened in 2017. Most people came in crypto in 2017. They remember this. No double top, no 320-day cycle corrections. Actually, in 2016 and 2017, I think we have one 320-day cycle correction. The market was just crazy at this time. This is the framework that people will apply in 2021. And to their credit, I was applying that framework too. I was a little suspicious because there were no 50% crashes in 2017. Now we were getting them. And it just took too long for prices to recover. But I still thought maybe we're going to get this parabolic run because up until 2017, we used to get them. But then in 2021, we didn't get it. And remember what I said about recency bias? That means that 2025, if you want to know what it's going to look like, it probably looks a lot more like 2021 than 2017 or 2013. That's what recency bias means. You want to know what the next cycle is going to do? Look at the last cycle. Recency bias. Now, I will say I will add a caveat here because we do have time and I don't have to make these short presentations. I don't remember these arrows or what they are. But in 2013, which is another year of a top, we do have one prominent Q1 top, a big 320 correction. This is an 80% crash, by the way. Doesn't look like much, but this is prices crashing by 80% in 2013. And then we have a Q4 high. Now, we did get the parabolic blow off top, but we do have, maybe it does seem like there's this pattern. And by the way, my forecasts are showing the same thing for 2029, the next top, showing the same thing where there are two peaks, one early in 29, another late peak in another late peak in Q4 29. That pattern only broke in 2017, really. And the pattern of parabolic blow of tops as we end the 4-year cycle, that ended in 2021. So you can study past cycles if you're a cycles analyst and kind of get some clues as to how the cycle is going to behave. But I think the biggest rule you have to apply is recency bias. If we don't go parabolic in 2021, we're probably not going to go parabolic in 2025. And now that the last two 4-year cycles did not end with a parabolic blow of top, guess what that means? It means in 2029, forget it. You're not going to get it. The next cycle, the best year of the next cycle is probably going to be 2028. That mid-year. We usually get 3 years up, 1 year down. Lately, what we have, I was talking to a buddy of mine about this recently. Lately, what the cycle has been is 1 year down, 2 years up, 1 year flat. So the last year of, not the last year, the second to last year, the third year of a bull market, let's just say, right? Because we go down for 1 year, then we have 3 years of a technical bull market. That last year, for the past two cycles, that means for the past two cycles, has been flat. No net return. Now, technically speaking, there is a positive return for Bitcoin in the year 2021 because the first 3 months are just insanely good. So the first 3 months we started to 30K, let's just say, when we ended up topping out. We ended up going to 60K. I don't know where the year ended. I don't measure returns that way. Like, what did it return on 25? What did it return on 21? What I'm really trying to measure is what is it doing on this last year of the 4-year cycle. And what it has been doing over the past two cycles, and that's a lot for Bitcoin because there's only like 4 complete cycles. And what it's been doing for the past two cycles is the last year is flat. And I would not be surprised if in 2029, people are calling for a spectacular blow off top in Bitcoin in the year 2029, even though already that pattern has broken. It's no longer true. It hasn't been true since 2021. And if we apply recency bias, we knew to expect the same in 2025. We got the same in 2025. That means that recency bias is more solid now. The last two cycles out of 4 did not produce a parabolic blow off top. So we're not going to get it in 2029. 2029 is probably going to be a shit year. You're probably going to do well if you just sell in Q1 of 29. And that's way too early to be making that statement. I know that, but that should be your expectations. It should be your expectation right now as we end the bear market in 2026. The expectation should be we're going to get a decent 27, we're going to get a very good 28, and 29 is going to suck. That's because that's what's been happening lately. That's what's been happening. I'm just applying that cycle framework recency bias. Now, the short squeeze. Why are we getting a short squeeze? I think it's the same reason that I just explained. People were too short. Everybody was short, apparently. I don't pay attention to that stuff anymore. I'm not on social media. I talk to people. And do yes, broadly speaking, I think everybody I talked to said the low is in October. The low is going to be in October. YouTube comments from people I don't know. Maybe they're good, maybe they're not. I don't know. But everybody like commenting on my video saying you're wrong. It's going to 30K in October. 30K in October, 30K in October. Had a conversation this week with some other guy who's talking about the cycle. He never talks about cycles, but he's talking about the cycle, saying that it's going to end 30K in October. Guys, if everybody thinks we're going to 30K in October, we're not going to go to 30K in October. That's how markets work. If you think you can tune into Twitter and just follow people's commentary and get some edge there, you're not gonna get any edge. It's just not. It doesn't work that way. So the fact that everybody thought the low was gonna be in October told me at least that it's probably not gonna get in October. It actually gave me some confidence. Let me bring back liquidity again. It gave me some confidence that yes, this was gonna be the 4-year cycle low here in July when nobody's expecting it. Fun fact, I actually wanted to do a promotion for Weiss for this low because I thought that's a bold call. It never tops out. There haven't been any 4-year cycle turns in Q3 of any year in Bitcoin. And this is basically early in the second half of the year. That's a bold call that you can then point back to and say, see, I told you. They didn't want to do it because the low is going to be in October. Like it literally telling me the low is going to be in October. Everybody thought the low is going to be in October, which yeah, to me was like, that's probably not going to be in October. Now, I'll admit that when prices didn't rally much here between these two dates, the June low, the late July top, barely any rally at all, I thought, maybe we do get a low in October, and everybody's right. But then the market did not really. So it topped out in late July as I expected from liquidity. It didn't really crash. It didn't really crash. It was very well supported. Then we start August and the market is rallying. It's trying to poke above the VTL. And then it's hugging the VTL. And I'm thinking, hey, maybe we get an quote unscheduled crossover of this VTL. Maybe we just cross the VTL sideways, which is what we did. Bitcoin just went on this sideways range, just trading sideways long enough to confirm the 4-year cycle low. 2 days later, short squeeze, boom. So that's the market realizing it's completely wrong in its thesis that we're going to 30K in October. This is the market saying, oh shit, I got this wrong. Now that means most people got it wrong. I will admit, no, I did not see this move. I did not realize just the sheer volume of short positions we had in Bitcoin. I didn't realize the market was this short. I had no idea. Just like 10/10 here, October 10, the market was extremely long at this time because October and because we had broken out to a new all-time high. So October, parabolic Q4, which had not been true at this point for 8 years. No matter, people still thought it was going to happen. So the market was completely mispositioned for this. I don't know if that's a term, but you know what I mean. And this is the same thing. It appears, however, that this trade was far more crowded than. So the Bitcoin is going to 30K by October thesis was so crowded. It's the only thing that I have to explain this move. I don't think it's Treasury QE because they haven't actually done any QE, any serious QE yet. So this is just the market realizing it's been wrong all along. And at this point, and I do want to read this question from Marcos, who I know is going to be watching the recording, and he had this great question. Let me just pull it up. There we go. So the question is, what is the evidence for the proposition that the low in Bitcoin is not yet in? In other words, we don't have the 4-year cycle yet. It's not yet in. What is the evidence for that? I don't think there's any at this point. I will say that when Bitcoin confirmed the 4-year cycle low, to me it was on Tuesday. So we had this great Let me zoom in way in here. We had a great rally across. Uh, there we go. We have this great rally here on Monday. Great rally. Bitcoin's up 2.5, 2.63% on no news at all. I thought, okay, that's pretty significant considering we've been hugging. I said this on the Discord. That's pretty significant. It's been hugging the VTL. It tried to cross over already twice. Now it's been hugging the VTL. Then it has this pretty decent up move on Monday. To me, that was enough of a confirmation, but I wanted to wait until Tuesday. What's going to happen on Tuesday? What happened on Tuesday is a whole lot of nothing. Bitcoin tried to sell off early in the morning. It ended up unchanged. I was like, okay, that's it. That's confirmed. But notice that without these huge green candles, that's still kind of a bold claim to say, that's it. The bear market is over. The low was here in late June. And liquidity is pointing down. And prior to Wednesday and Thursday, the market was it Wednesday and Thursday? Yeah. The market is, and it's 3 days. Unbelievable. Friday too. Um, the market is still somewhat arguably still following Japanese M2 up until Tuesday of this week, I would say. Still following that Japanese M2, arguably. It's not going to follow it move for move. It's not going to do that. So we could dismiss this sideways trading with a downside bias, this deviation as just noise, just the way that the pattern usually works out. What I mean by that is by Tuesday, when I'm pretty sure the 4-year cycle low is in, from applying the framework, not because I'm a genius or a wizard, I'm just applying the framework. Still pretty bold claim because Bitcoin's trading for 64K. The 4-year cycle low candidate is just about 10% below current prices. And what I'm saying is it's going to go down for 2 months, but it will not cross 58K. That's pretty bold. And I will admit, it gave me some pause. I was like, we have 2 months of selling. You know, these are just timing tools. Can we really hold above 58K? Well, not back then. Now I think we can. So to answer the question, Marcos, when you're watching this, after Bitcoin tested 80K this morning, having made a low at 58K, having negated the bearish liquidity outlook for about a month. Bearish liquidity outlook, keep in mind, started on July 23. I'm recording this on August 21, a month later. That means we only have about 2 months of downside. The expectation was 3, and we tested 80K again. The expectation was 70K tops. And at this point, there's not a whole lot of evidence. The only evidence I can think of that would negate that late June was a 4-year cycle low is an immediate crash. And I mean prices crashing. Just like they went up in a ferocious way, they need to come back down in an even stronger way. Maybe then we can say, all right, maybe it wasn't the 4-year cycle low. I would say at this point, we did not only cross the 320 V2L, we surged above it. I have never seen this not be confirmed. Or rather, there was one time when this was not confirmed. I'll show you. It was the COVID crash. So the COVID crash, we have the 320. By the way, this is slightly different, but it's the closest thing I can think of. Let me just say, the exact analog in 2018, 2019 is this crossover here. So it's a fact, it's this incredible, because it's very similar, because Bitcoin crosses the 320 low VTL in late March, and on April 1st, it surges by 20%. So like 3 days later, boom, it surges above the VTL. And to me, that just confirmed that December 2018 was a 4-year cycle low. It took a lot longer to confirm than this time around, but that was back then in the 2018 bear market. We got confirmation in late March, and the 20% surge in April, I think it was April 1st, not 2nd, and April 2nd, to me, that was more than enough evidence. That is definitely a 4-year cycle low, December 2018. Now, so I cannot go back in time and say, yeah, this is the time when the 320 VTL was crossed, and it gave us a false hope. It gave us a false signal. The market actually made a lower low later. There is, however, a pretty strong denial of a VTL that took place in 2019. It was right here. We have this. This is an 80-day VTL, so these are 80-day cycle tops. This is not properly drawn. It doesn't really matter. There we go. Let's do it right. There we go. So this is an 80-day VTL, and what this did is negate a signal from an 80-day VTL. So we got this. That meant that this was a 320-day cycle low, and this was later denied in March of 2020, COVID. So an external shock. An external shock made the market make a new low right here in March of 2020 when the low was supposed to be this. And you can see that it looks a little weird because it is having a pretty decent rally and all of a sudden it just crashes. And it crashed by 50% in a single day, 40% from close to close. The whole crash was 50% in 2 days. Actually, I think it's 24-hour period, but because of how they cut these bars off, it looks like 2 days. It was just one day, 50% crash. External shock. Now, we went over this in the last AMA. This one was also the dial of a VTL. Now, technically speaking, my model doesn't even have this VTL, so this is not the best analog, but let's discuss it anyways. Um, we have this VTL crossover. It told us that the 80 days, sorry, the 4-year cycle low probably took place in October, September, October as a double bottom. We do have technically a new lower low here when FTX crashed, but Ethereum did not confirm. I think Solana did not confirm. Like the altcoins were not making new lows. They had bottomed in June. So another external shock, it seems to have only affected Bitcoin. So to answer the question, this is an external shock, or at least it's acting as an external shock. The market is up enormously over the next 3 days. What would it take to deny that? Another external shock. So as we head into October, and we're probably going to head down into October based on Japanese M2 and central bank liquidity too, we're probably going to get an October low. It's just going to be a higher low. What would it take for this to be a lower low? Yet another external shock. The only thing I can think of is Michael Saylor suddenly going bust, but I don't really think that's going to happen. I don't think that's a serious risk, at least not for this cycle. He's not that exposed. Um, I don't think there's going to be another FTX. The only chance this is not a 4-year cycle low in July, June, July, is that we're gonna get another external catalyst, a nuclear device detonated in the Middle East. I don't know, something like that. And I don't wish for this, by the way. I'm just saying it needs to be something that the market is just not seeing at all. And this is after a legendary short squeeze, probably the biggest in crypto history, being an external shock in and of itself. So we already had a positive external shock. These are very rare. These don't happen often. These types of events where the market just completely blows off in one direction or another without any apparent catalyst, these are pretty rare. Having another one to deny this one, that first of all, that never happened. That's never happened before. Those rallies I showed you before from 2018, 2019, 2022, they were organic rallies. It was the market just doing its own cyclic business, going about with business. I don't know how to say that. Business as usual for the markets. We already had an external shock and it was positive. We need another external shock to deny this 4-year cycle low. I don't think we're gonna get it. I think the lowest we're gonna go is maybe 65, 62 as we head into October, and that's gonna be it. So this October thing, we're gonna get an October low probably. It's gonna be a higher low, and that's what most people did not expect. People thought the low, the 4-year cycle low, the bear market bottom, October, Q4, like it always does. It took place in Q3, and it's never done that before. And yeah, that's how cycles work. Expect more of this as time goes on. And I believe the reason why did the cycle pattern break now, or shift rather, didn't break, it shifted. Why did it shift now? I believe the reason it shifted now is because this market is a lot bigger now. It's a lot more crowded. So this popular wisdom of the 4-year cycle, the halving, all of these truisms about Bitcoin, all of them are going to fall. Already, we don't end bull markets in parabolic blow off tops. We don't do that anymore. Already, we are not going to start bottoming in Q4 and topping in Q4 every single time. Already, we're not going to have these 12-month Bear markets, they might be longer, they might be shorter. Anybody who understands the cycle framework knows we could have a 4 year cycle where Bitcoin goes up for 2 years, and then it goes down for 2 years. We're going to see all of this stuff play out as we go forward over the next, I don't know, 10 cycles, over the next 40 years. We're going to see all manner of different shapes to this 4 year cycle. It's going to become unpredictable. And here's another prediction. Most people will probably say at that point that the cycle is dead. It doesn't matter anymore. It used to be cyclical, not really cyclical anymore. That doesn't mean the cycle is gone. That just means it shifted. It's not so obvious. The pattern is different. It just changed. It matured. That's what it always does. That's why you don't have an obvious 4 year cycle on the S&P 500 or the Nasdaq. It's not an obvious cycle. It's there if you know how to find it, but it's not obvious. So the market and Bitcoin, they're not obvious anymore. They're a little harder to trade. They're a little harder to predict. But the cycle hasn't gone away. It just bottomed in July. That's all it did. By the way, my model uses a 3.5 year cycle for Bitcoin. I don't know why I have that. I do have that because we have a 320 cycle, and that times 4 is 3.5. So the ideal cycle duration, ideal, is not really 4 years. It's actually 3.5. So we might get this a little. The cycle might shorten in the future. We might not see exactly 4 years. It might be a little less than that, 3.5, in line with gold. And that would make sense because gold is the closest analog to what Bitcoin is supposed to be. Makes sense that those cycles would be shared a little bit. I think I actually have a 4 year, an 80-day cycle on gold too. Not as prominent, but I think I have that too. Anyways, big rant. It's been an hour. Wow. I'm gonna get to your questions, and I'm gonna touch on metals. So you have to ask me about metals. So that's what I think is happening. Doesn't make it right. But yeah. Whale psychology living free in our heads. Great comment. Yeah, it is. It is. Might we find liquidity timing offset is in a drift, as discussed earlier in the morning? Yes. Yeah. Yeah. This might be a liquidity drift. How would I test this? It might be a liquidity drift. I'm not ruling that out. I'm just not willing to say, yeah, that's definitely what it is with the information we have today. I'm not willing to say that. So that's 26. All right, so that's 110, I think. Okay. So this will be the new drift, 110 days. Um, does it fit? You're gonna notice, no, it doesn't. I mean, I guess, does it fit? Good question. Not perfectly. I tend to check these mathematically with doing a grain share causation. 110 days did not show up as a proper offset. Has it shifted? Maybe it has, but what I would argue is if it has shifted, and yeah, it looks pretty good when we shift by 110 days instead of 84. That doesn't. I would expect. Sorry, I have the cat here. I would expect that offset to be returned to 84. Now we're gonna know because if if the offset now is 110, not saying it is, saying it's a possibility, then the low is going to be the next low. And I want to buy this low, by the way, personally. This is what I think the buy signal is. Um, the low would be mid-November instead of mid-October. It's not really willing to bet on that yet. For me, I'm just going to expect to see me use the classic 84-day offset and just say, hey, this is just a short squeeze. It didn't quite line up with liquidity, and that's all there's to it. Not every move has or will line up with liquidity. It can vary. Now, is this shocking? Yeah, it's a little shocking because I get so used to using liquidity to predict Bitcoin and to see every move that Bitcoin does in liquidity. I get so used to that when I see something that does not show up in liquidity, I'm a little shocked. I'm like, wow, what is going on here? Um, but it can happen. It can happen. And you remember me saying many times, I don't expect this correlation between Japanese and two. and Bitcoin to be this strong going forward. I don't, and by the way, I'm not saying this is the beginning of that correlation breaking. Not saying that at all. That would be a cop out. It's not what I'm saying. What I'm saying is this correlation will break. And from time to time, even when the correlation is strong as it is now, expect it to break every once in a while. It's not the only tool you should use. Not at all. Which is a nice segue to saying, look at bonds. Look at the bond market. Because this is something that I think we should. I've not been using the bond market as a proxy for Bitcoin because I didn't think it was working. But there is significant, and I need to flag this. There's significant deviation now between the bond market, which we know predicts Bitcoin 13 months ahead of time, and liquidity. Liquidity is saying, I mean, these two are in opposite directions now. They're saying liquidity is saying low in October, Bitcoin should be dropping. This is a, oh, sorry, this is a weekly. Um, this is a weekly chart. Liquidity is saying we should have had a top in July, and you're gonna get a low in October. And I was following liquidity because the correlation between or the predictability that liquidity has over Bitcoin is much stronger than the bond market. But guess who predicted this? Who predicted this? Bonds. Bonds said low in February, we got that. They said we're gonna get a rally into May, we got that. Then we're gonna get a prominent low, and I thought liquidity was gonna show the same thing. We're gonna get this late June low, but then we're gonna rally into November. We're gonna get a rally into November. This is where the nuanced discussion begins, because which one is right? It looks like Bitcoin's following bonds. Not really, not GLI, not liquidity. It looks like it's following bonds, and it looks like the top is gonna be in October. But check this out. I have to show you this. And I know not all of you have access to the app. Some of you do. Send feedback, by the way, whenever it suits you, because I'm really looking forward to that feedback. You're going to help me fix bugs and catch them much faster than I ever could by myself. So if I look at the 80-day cycle, I've been saying a lot that the October low shows up on the on my on the forecasting, on cycle forecasting. It shows up as a top though. So who agrees with the bond market here in saying there's a low? Literally June 29 is when this thing says the low should have been. There's a range here between June 19 and July 9. That was spot on. The forecast for Bitcoin on its 80-day cycle is for a rally into October, just like the bond market is saying. Why was I so quick to dismiss it? I was quick to dismiss it because I tend to look at liquidity first and then bonds and the planets second. But the planets and bonds agree. Bitcoin should rally into October. Is that my base case? No, it's not. But it's a possibility. And it's a possibility that at this point, we cannot dismiss. It looks like it might happen. Now, I think I also dismissed it because I don't think it shows up here on this. Oh no, it does. It does. So notice that on the 320 forecast, same thing. We have a projected top between the 7th of October and November 16. I assumed this was going to be an inversion. I did. And by the way, this is how this works, guys. I mean, I don't know everything. I get stuff wrong all the time. I'm just using a framework and I'm leaning one direction over another. In this case, I have liquidity, which is a very, very strong indicator in and of itself, saying low in October. And yes, I have a bunch of other things saying high in October. I tend to side with liquidity because liquidity does not invert. These forecasts invert all the time. Look at this one. This forecast is spot on for the low in February, spot on. And yet it showed up as a high. Forecast said it's a top. And if I look at the 80-day cycle, it showed up as a top too. It did not show up as a low. Oops, sorry, no, I'm wrong about that. No, look at this. Showed up as a high. Then this one, minor low in early March, and then the models got back to their traditional alignment again. But this forecast for a high was a low. So this forecasting model, it can invert. So if it shows a turning point in October, my liquidity indicator is saying that's a low in October, I'm just going to say, oh, it probably inverts again. Same thing is true for this one at 320. And bonds, why would I dismiss bonds over liquidity? Because bonds don't predict Bitcoin as reliably as liquidity does. So I dismissed it. But it is a real possibility and I wanted to flag it here. Maybe we're actually heading for a high in October. It could be. Uh, and I still don't think that's what's going to happen because uh, that alignment with liquidity, if you had seen the numbers that I have seen, it's very tight. Like I'm talking p values for anybody who knows what that is. It's like it's 10 to the power of minus 25 or something like that. It's ridiculously small at the 84-day offset, meaning it predicts Bitcoin with extreme reliability. And it's not the only period, by the way. There are other sub periods, other offsets that kind of work. I don't know if 110 is one of them, but I know that I think 20 is one of them, 30 is one of them. But the strongest offset in terms of its statistical power, predictive power, is 84 days. And so, and it's the strongest of all. So it has a stronger correlation than all of my forecasting models. It has a stronger correlation than bonds, global M2. It is the strongest prediction, full stop. And so when it's saying it's going to go for a low in October, I tend to pay attention, even if literally every other model is saying it's going to be a high in October. Am I wrong to do this? Yeah, maybe I am. This is why I share the app. I share my framework so that you can all make your own decisions. I don't always get it right. Maybe if you had looked at my framework, the bonds, the forecast, you would have concluded that no, we're probably going to get a high in October because more models are saying high in October than low. Only a single model is saying low in October. It just happens to be the strongest model though, the one that's most reliable. So so this is just me. It's just me sharing how I think about these things. Sometimes there are conflicts, and you just don't know how to reconcile them until more evidence comes in, and you go, "Oh, I'm going to lean this way versus that way." I'm still thinking low in October, by the way, just a higher low. But I'm sharing with you, in the interest of complete honesty, that my models are definitely highlighting a high in October, just not liquidity. And I want to see liquidity. I confirm everything through. I run it through the lens of liquidity with Bitcoin, not other markets. But with Bitcoin, yeah, for me, it's what is liquidity saying? Because these models invert, because bonds are not as reliable. So so yeah. Now, gonna keep answering those questions. Back to bonds. Notice that bonds are pretty much lining up perfectly with my forecasting model. So maybe Bitcoin is headed for a high in October. I hope not, because I don't have a lot of it. I have exposure. The vaults are doing fantastic. If you want to check those out on the Discord, if you're not in the US, you can join them. They're doing great. I think one of them is already up like 5%. So the bear market is over for that strategy. Another one is on 5. And another one I changed recently. It's up like 25 or 30% this year. It's pretty good because I changed the strategy. So it's not like I don't have exposure. I have automated exposure. And by the way, I make a point to divorce my analysis from my trading because I never would have bought into this breakout. And yet my vaults were buying early. They were loading up like early. Like I mean in this period, early August, the vaults started buying. I thought it was insane. The most insane trade that I saw that was like, man, I got really close from just manually shutting down that trade. It decided to buy Ethereum on this date, on July 15 at 1900. And I thought, that is crazy. There's no way that trade is going to work. Again, just being honest. I don't know everything. That's why I use algorithms to trade. Um, Sorry, it should bring up algorithms because I realize most of the algorithms on the app are wrong. Not all of them, but most of them, and that's just disappointing. Um, anyways, but I bought here 1900. I thought that's a stupid trade. It was a great trade. It was a fantastic trade. I just had to wait for like a month of nothing. I never even if I had taken the trade, I would have canceled it. I would have gotten out of this trade. I don't have this level of discipline. I just don't have it. And I'm just look at me. I'm so happy. The Vaults are doing great because they traded by themselves, blind, with no emotion. And yeah, I think those strategies are going to make it into the app at some point because they're the most tested, validated, solid strategies I have. Whereas the stuff you see on the app today has not been battle tested enough yet, unfortunately. Um, all right. Love this deep dive into bonds comparison inversion periods. I don't understand why inversions happen. I don't understand it either. ES. but they do happen. With the planets, not with these, not with liquidity, not with bonds. They don't invert. They don't. They either follow or they don't. The reason I'm saying that is because the correlation with these bonds and liquidity is very, very, very strong. They don't invert. Sometimes they're wrong, but I have not seen any evidence of inversion. Whereas I just showed you with the app, and I'm going to show it again in a minute. Uh, Inversions are very clear. Like it is like a turning point happens exactly on that date, but it shows up as a high on the model, whereas you got a low. This is very common, very, very, very common. If I can identify the causes for that, maybe I can get rid of the inversions at some point in the future. I would love to do that because I think it would make the algorithmic trades a lot more reliable, a lot more predictable. But right now, um, yeah, right now that's we just have to deal with the fact that there are inversions and the algorithms do not take direction of the forecast into account. They can't. It doesn't work if you do that. All right. Let me start from the beginning because I think Perry has a bunch of questions I haven't answered. Oh, oil, gold, yes. 110 offset is found. 110 offset I found instead of 84, but nothing else fits previously. Exactly. You would have to do the Granger causation. Um, I could share those scripts. I mean, this is not proprietary stuff like a Granger causation test. I have a script that you can run, a Python script that can test it tests this stuff for you. It runs from CLI right now, command line interface, so you have to like open a terminal, but I could turn it into a little app thing. It's probably going to be useless to most of you, but you can check for these correlations yourself and see that I'm not making this stuff up. Remember, I built all of these tools, indicators, vaults, apps for me. I'm the first customer. I'm the one who uses them every single day. So um, so this stuff works because I need it to work. I'm using it myself. I'm not even selling it. So all right. So question Perry says institutional money is distorting the free market energies, the ones we got clearly in the past, like blow of tops, or institutional money is the new energetics and manipulate the markets like this pump now. No, neither, I would say, Perry. There is no manipulation. This is just markets being markets. They're not as predictable. The cycle picture can be distorted. Those of you who come from the Ray Merriman school of thought, let's just say, you know they call it distortion. Hurst never used that technical term, but Hurst does say, and I do repeat this, not verbatim, but I quote this in my own lessons. I think it's in lesson one of the principle of variation. This is my own take on Hurst, actually. Hurst refers to variation as cycles, amplitudes, and frequencies varying over time. What I added on that part of that lesson is I said there's also variations that are caused by external shocks. These variations that are caused by external shocks completely distort the cycle picture. But they don't distort the timing. They distort the amplitude of the move. In other words, because the market was so short, we got this huge rally. I don't know when the next 20-day cycle high lands. Expect it to be significant when it lands because the timing is not going to change. Let's say the next 20-day top is on September 1st. That September 1st top will land on time and it will take prices down on time because these shocks only increase the amplitude of a cycle. They don't change timing at all. So what's going to happen is this cycle, this is a 20-day cycle that's taking place right now. Its amplitude is dramatically higher than anything around it. Anything before it and likely everything after it is going to have much lower amplitude. But this particular cycle has incredible energy because of the short squeeze. It's the same thing that we saw in the COVID crash. Why did it crash so hard? Well, it crashed like this because a lot of leverage, a significant external shock took place, and it distorted the cycle picture. I don't know if this makes sense to you. The way I see it in my head, this low here, I wish I could just change the price action so you could see it, but this low should have been higher. Bitcoin bottomed on a closing basis at, let's say, 5K. That low should have been about 7 to 8K. Should have been a higher low. In other words, yeah, the sell-off should have taken place. The market had already turned down. It was picked up by the FLDs. Like we could see it. I could see it turn down, but I could not see 5K. and a retest of 3K or 4K, whatever it was. I thought it was going to go to 8 to 7K. So I saw using timing, I saw the correction, not the amplitude of the correction. This rally is the same. Before the rally took place, I noticed, hey, we're getting a breakout here. This is a 20-day cycle low. I thought we're probably gonna go to, we're probably gonna do something like this. We're gonna go to, I don't know, 68. We're gonna do something like this and then head back down again. But something added energy to the market. That's how I'm starting to think about it in those terms now. Something added energy to the market. It's not manipulation. It's distortion. Something is adding a lot of energy in a very short period of time, and that's what a short squeeze is, basically. Or when longs get liquidated, that's what it is. It's a lot of people putting on the exact same trade. At the time we should have, we would have, I think if you look at my model, you're going to see that there was a 20-day cycle low around this time, predicted, but not this magnitude of a move. That was not predicted. That was not foreseeable. It was not, I mean, you can predict it if you use a different framework, not this framework. Because you're never going to see these distortions using cycles. Cycles, the one downside is that you think in terms of normalcy. Like, what's normal? What is normal amplitude? What is a normal duration of the cycle? That is the biggest downside. That you don't see these. You just don't see them. Your framework does not pick them up. It doesn't invalidate the framework. That's for you, YouTube. Because somebody on YouTube was like, your framework is invalidated. No, it is not. These things happen. It is a known factor, known quantity, known risk. It happens. Why do I still use the framework? This happens every once in a while. These types of shocks happen because even 1010, we knew 1010 was going to happen because we knew that October 17 was going to be a prominent low. Those of you who were around at the time, we were expecting this. So 1010 we saw using the framework. This one, no. Does it invalidate the framework? No. These are one of a kind type of events. They happen every few years. People used to say they would happen once every 50 years or whatever. Not really. I would say they happen once every 5, 6 years. You're going to get shocks like these. It doesn't invalidate the framework at all. In fact, if the framework only stops working briefly every 6 years or so, it's a pretty good framework. I hope you agree with that. All right. Keep going here. So should the squeeze, anything opposite, so many long short, be viewed as natural market manipulation? Neither. It's just normal. It happens every once in a while. It's maybe both in that market manipulators are part of it. But that's it, Ferry. Yes. Market manipulators are part of the market. And this is not manipulation. This is mostly at people's hairs being on fire. This is mostly a margin call. And I do think that at this point is the third day of the rally. Maybe at this point is momentum traders using leverage. Maybe at this point. Wednesday is a short squeeze. What happened in Thursday and Friday, I don't know. I haven't looked. But it's clear short squeezes are easy to see. It's when the market goes vertical in one direction. That's a short squeeze. Because people are buying regardless of price. The same thing happens during crashes. People sell regardless of price, which makes the market go vertical. You need a very special and specific set of circumstances to have that happen. In this particular case, I believe what happened is everybody just bet on that October low, just too much, with too much confidence. People were too confident of the October low. I think that's what it was. It's a theory. I can't prove it. But what I can say is there was a lot of shorts out there. I believe it's the biggest short squeeze in crypto history. We can point to that and say, hey, if it's the biggest in crypto history, that trade was arguably quite crowded. I didn't realize how crowded it was. For one simple reason, guys. Shorting crypto is not a great idea because this stuff happens. This stuff can happen. Even your stop losses are not going to work. So I never short crypto, ever. Even if my vaults are long only, I'm not going to go short because these things happen. And when they do, your head catches fire. Not a good idea, in my opinion. These are moments of extreme illiquidity. You may not even be able to get out. Unless you're day trading, very short term, you're using a 4-minute chart, you're going to get some slippage, but not a lot on that exit as the market catches fire. Most of the returns come from being long anyways. It's just not worth it because crypto's fond of doing this. And when I tested my vaults before I put them on Hyperliquid, I actually did a few audits on, because the returns are good. I knew that, but I wanted more. I wanted to understand where the return comes from. Why is it outperforming the market? Why is it making money? It's days like these. It's days like it's short squeezes. It's like extreme right tail events. Basically, that's most of your P&L comes from that. So that's why you're gonna see the vols if you're following them. You're gonna see them strike out a lot, try to catch moves that never take place, because every once in a while you get these, and it makes it all worth it. So you have to have the patience of a robot to trade that way, but I think it's worth it if you have the right framework. Those vaults do not go short. They're never going to go short. I like them long only, just as they are. The market is the greatest psychological humility teacher. Absolutely. I actually like it because it breaks the illusion that you're in control and that you know what's happening. You don't. I didn't see this move coming. I want to be very clear, especially with you, YouTube. This does not invalidate any of my work. I've seen these. This is not the first time I see this, and I'm still using the same framework, and it's still mostly right. It doesn't invalidate anything. But I have to respect the move. And when they happen, it humbles you because I mean, even after I saw the move on Wednesday, I thought, okay, probably carries through to Thursday, and then by Thursday we end the day unchanged. Nope, we just kept going. We tapped 80K this morning. Shocking. I never saw it coming. Um, Sandeep, that was about an hour ago. Add comments. Data that confirms that. I don't know what she was talking about, but Sandeep, feel free to interrupt at a future point. Let me just go through these first, though. Personal request. Please keep in mind that we have limited time due today to Juan's hard stop. There are other markets to cover too. We ran out of time previously with long commentary. Sorry, Barry, I just talk a lot. I know that. And an updated, what about the bonds indicator? An updated T-bill indicator. Perry, I showed the bond indicator. I have not updated T-bill indicator. I haven't. So I can show you through July, but I can tell you that the reason you don't see it here anymore is because it kind of stopped working. Um, it sort of stopped. It wasn't really. Uh, Now, after what happened, I definitely want to know what the T-bills are saying. Definitely. Where is this thing? No. Pin to scale C. No, I need to pin it to a new left scale. There we go. Nope, but whatever. Let me try and bring it up again. I don't know why it's acting up. I need to pin it to a new scale. Pin to scale, no scale, full screen, right scale. There we go. Ah, I know why it's doing this. My bad. I don't remember. I don't even remember the offset on this thing. No, I shouldn't bring it up here. Should bring it up here. Oh, I have it. I already have it. So I haven't updated it since July. So it just shows a flat line. It wasn't following it though. It was not following it. That's why I stopped looking at it. It worked for a while. I actually saw that on an article on CoinDesk or Cointelegraph. It was a pretty well put together article. It was using my framework. They were doing Granger causation, and they were testing it against a bunch of things. And what caught my eye is they noticed that the Fed balance sheet is not causing Bitcoin. And I was like, oh yeah, I noticed that too. I wanna read the paper. And I read it, and their conclusion was you should use T-bills. I will update this indicator. I'm definitely curious. But notice that this is a monthly indicator. It comes from the Treasury's own website. They have an API. Kudos to them. You can pull that data and create an indicator of your own. That's pretty cool. It only updates once a month though. And I stopped looking at it because there's no resolution to this thing. I mean, bonds are showing the May top and the low in early July. Bonds are showing that. Liquidity showing that. T-bills, no, they're not showing anything. So I tended to dismiss it. And another reason I dismissed it, and this might be too inside baseball talk for you guys, but I think you should know anyways. Um, the reason this indicator works so well, T-bills, is because you're not detrending the market. But notice that the black line is bonds. And let me bring up CLI. You look at this and you might go, there's no correlation between Bitcoin and bonds and liquidity. That's not true. If you look at the year-on-year returns, that's when the correlation shows up. This is not looking at year-on-year returns. You need to detrend all of these. You need to create um, um, a, a mean reverting series. You need mean reversion to check these to test these correlations. The app that I have does do that by itself. You have like three different methods for detrending. So we detrend. I look at daily correlation, daily Granger causation, and then I do what works, which is log over year-on-year return. So it's log over year-on-year return, and that's when you see it. You don't see it otherwise. I think the guys in this paper were not really doing that. So they were looking for like raw causation without the trending, which is why maybe they missed these ones. You're gonna miss central bank liquidity. You're gonna miss Japanese M2. You're gonna miss bonds if you don't detrend, if you don't apply that year-on-year log detrending. You just miss it. You look at this chart and you go, the only thing that's causing this market is the green line, and for some reason it fell completely out of line. So that's a long way of saying I don't think it's such a strong indicator. If we go back beyond 2020, it didn't work at all. Notice, didn't work at all. Started working around 2020. Seems to have stopped working around February 26th. I think it start working again once we get a bull market. I'm definitely gonna update the T-bill indicator, and I think it's gonna work again. It wasn't working this time around. This just wasn't. I would say the closest thing, it seems like the strongest macro tool now, shockingly, is bonds. Bonds are great because they allow you to see 13 months ahead of time. Liquidity is not working here. So you know what I think about that, though. I think it's just short-term cycle distortion. I don't think it's Bitcoin lining up with bonds. I think it will line up more closely with liquidity. I do. There is also a low in October in the bond market, but why should we make of this low in October? It's probably noise. I don't know. You figure that out. You be the judge. Wasn't the T-bill offset something like 5 months? Yeah, Barry, I think it was I think it was 34 weeks. How much is that? That is, oh, come on. Yeah, that's 8 months. It's about 8 months offset. But to me, it gives you like the broader uptrend at best. And I do want to see. So here's what I require of these liquidity macro indicators. I want to see the 320-day cycles. I don't care about the 80-day cycles. I don't care about 20. I don't care about 5. The same is true of my own forecasting algorithms, the planetary models. They don't predict the 5-day cycle at all. They're horrible for that. They don't really predict the 20-day cycle either. They're not good at that. I don't care. I just want to predict the 80-day cycles and onwards. And by the way, they do a pretty good job of predicting 20-day cycles, the planets. The macro stuff, I just want 320 or above. I don't care if it doesn't predict 80-day cycles. Liquidity sometimes does, sometimes doesn't. But it always predicts 320s. Always. And bonds too. T-bills don't. So how useful is it? It's not, I don't know. I don't know. Maybe it's because I like to use my own tools and this is not really my own tool. I don't remember who put this together. Honestly, don't remember. I remember that I saw it on Cointelegraph. That's all I remember. ES is saying I'd love to access the app. Yes, more of you are going to be able to access the app soon because I need more feedback. And I know you guys are using it, but they're not those channels are a little dead. Nobody's sending feedback. I need that feedback, guys, especially with the update I pushed yesterday, which is all about AI tools. And in order to know if an AI is working, an LLM is working or not, you just need to prompt it a lot because it usually I've talked to the AI assistant on the app. It mostly works. Sometimes it doesn't. Sometimes it makes no sense. Or it says things are not exactly correct, or LLMs do this a lot. They answer questions you never asked. They answer their own questions because they thought about that question in their own thinking process and they answer it back to you and you never asked. I hate when it does that. So you need to refine the harness so that it answers only when spoken for and it only answers the things you want to know. So check it out, test it out. I'm gonna open it up more now because yeah, I'm not getting enough feedback. Perry, that it absolutely excludes you, and I know you and I need to meet. It's just I'm fixing backend stuff. Like this bug that I found this morning with the training strategies, that's top priority. You're never gonna see that bug. I only see it because I have access to everything, and I know it's wrong. So I had to fix it, and that's priority number one. Until it's fixed, I'm not gonna pay attention to design, UI, or anything. Just fixing bugs. All right. So Natasha is saying, Juan, which vault is best to start right now? 20-day or your shitcoin? Shitcoin is dead. I retired the vault. It's not active. It's not gonna be active. 20-day, 1 out of 2 is the best one. That's the best vault. That vault is up 5%. I launched it in June, I think, June of 2026. It's up 5%, whereas Bitcoin is just crashing. And then there's one called, the other one is called 20-day cycle, something like that, 20-day cycle, 2 out of 2. That one is remarkable. I think it's extremely good, probably the best, but I haven't tested it enough yet. It only came online in late January. So if you look at the track record on that one, it was free falling. That's an old strategy. And what happened is, this is not lying or anything. What happened is, because the strategy was not working, I was going to retire it. And instead of retiring it, I changed it. Of course, it's the same vault. So you see the entire track record. But if you look at 2 out of 2, 20-day cycle, 2 out of 2 from late January, early February on, you're going to see it's pretty remarkable, that one, because it managed to make money. Whereas the one I like most, 1 out of 2, it didn't, it broke even. So there was no bear market for it. The most it was down was 9%. While Bitcoin was down 50 or 60%. It was down 9. So the reason I like it the most because I designed it as a long only strategy with low volatility. And that's exactly what I got. Whereas this new one, 2 out of 2, that one seems to make money, seems to avoid bear markets and make money, but I'm not sure. I think it's more like it makes money on range bound markets because that's the nature of that strategy. Whereas when the bull market returns, 1 out of 2 is going to do better. So those two are my favorite ones. Sorry, I'm late. Gotta work for a living. Did we talk about gold, silver? No, we're gonna start with that now. Add energy equals amplification. Absolutely, Barry. All right, so yeah, I do have a hard stop, so let's go to metals. I actually had a chat with a buddy of mine yesterday. We talked about metals for like 40 minutes because he's a gold bug. I mentioned him before. Um, so I have a pretty good view. I have a pretty good idea of how to show you what I think. Suffice to say, I think gold and metals are range bound. But the best way to explain why is to look at the forecast. Not really. I don't think we have evidence from price action. So let me switch back to the app. So here's the app. Here's gold. And I'm just gonna do the same thing that I walked my body through. So I started with a big picture. And I want to show you, I'm using advanced mode. I shouldn't use advanced mode. Those of you who are using the app, don't use advanced mode. It's too much. I rarely use it anymore, but it's there. People want to tinker with the models, look at alternative models that you're never going to see and the algorithm's never going to use. Those are all there in case you want to, oh yeah, tinker. That was Margot. Margot suggested I do it. I said, yeah, it's a great idea, actually. Just let people play around. That's like 5% of users, but it's still all there. All right, so we start big picture. We notice the first thing you got to look at is correlation. How strong is the model? Now, every correlation metric you see is out of sample. This is not a correlate. Out of sample means the model didn't see data and it was evaluated on data it never saw. And that correlation is 98% for gold's 14-year cycle. Big disclaimer there. Because there are not a lot of iterations of the 14-year cycle, these long-term cycles tend to have very high correlations, and they're not necessarily that good. As an example, they have a big margin of error. For instance, in this case, a 14-year cycle forecast on this very good model, 98% correlation, is anywhere between mid-February 2023 and August of 2026. So it's given itself a lot of room there. And yeah, that's by design. These are the margin of error in any one of these forecasts is proportional to the cycle you're trying to predict. And so 14-year cycles, we have a big margin of error. It's about 12.5% in both directions from the ideal date. The ideal date of the top, November 17, 2024. You can see that the recent high landed there, but it was late. It was toward the end of this window. Again, out of sample correlation, 98%. That's a very strong model. What can I say? It's strong. It's pretty good. But it's not my favorite. Notice that, for instance, even though it is extremely comfortable margin of error, it says that the last 14-year cycle low was supposed to be between March 2017 and September 2020. Actually, the low is in December of 2015. So even with a large margin of error, still got it wrong. And why am I saying that? Because I don't pay attention to this model very much. I don't use it much, but it's still there and it is still saying high. And not only that, notice it was late, but it wasn't wrong. Gold was just range bound at this time. It really started taking off pretty much around this date, December 2018. That's when it really started. You could argue that this was not wrong, that it was just picking up on the fact that this is when the cycle started going up. And yet technically we have a lower low here, but it's not that wrong. All right. And of course it nailed this one. 98% correlation means it's probably nailing most of these turning points. It inverted here. You see this inversion showing up as a high. It's actually low. I don't know what this is. Like I said, I don't love this model. I don't use it much, but I do want to show it's showing a top. All right, so it's showing a high. Then we go, and this is how you need to do this, by the way. I mean, if you have no opinion on the market and you're really just looking at it for the first time, what I recommend you do is that you go to the longest cycle and you work your way backwards to the shorter cycles. Ignore anything that's 5 or 10 days. That's just noise. And we do have an 80-day cycle on gold, but the model produced no acceptable forecasts. That means they don't pass the minimum requirements that I have for them. I don't remember off the top of my head what they are, but I now have like a minimum requirement for what is an acceptable forecasting model. 80-day cycle is grayed out because nothing passes that minimum threshold. So what we're going to do here is we'll start with 14 years and we're going to walk backwards to 160 days. So what is the outlook for the 14-year cycle? Bearish. It's bearish. It says gold should have made 14-year cycle top. Then we go 7 years. 7-year is a much better model. The correlation is slower, but that's because there's more iterations. Like I said, less iterations, higher correlation, more iterations, lower correlations, but the models themselves tend to be better. The 7-year mark, already pretty good. And this is almost right on the money. So it still has a margin of error, but it's saying the same thing. And ideally, it pinned gold's high around March 4, 2026. I think the actual high, I believe, was in January. Let's see, January 28th. The current price isn't updated on the models. No, it is not, and that is on purpose, Perry. I want to show that these forecasts took place without knowing, because this is what I'm showing you. Here's the local version. The local version is what's used to train models. So you can see these models have no idea what happened later. No idea that prices went down. No idea. I just want to put that on the record. If I show you with updated prices, somebody on YouTube could come along and say, hey, you knew that would happen. You knew that was going to show up. No, you can see it right here. These models are trained on data that runs through March 2026. And honestly, on these models, data ends way sooner than that. It ends around, I don't know, like 20. I don't remember. Off the top of my head, I don't know. I don't know if I have this here anymore because I got rid of it. Let me see. Hopefully I can show you. There we go. So this model, data ends March 31st, 2024. It has no idea what happened in 25, 26, no idea. And I want that on the record. I want that very clear. I want to show you that I'm not making this stuff up because people think that I am. I'm not. You see, prices run through March 26, and this particular model doesn't even see 25, 26 data. It has no access to that. Not only that, even data that it had access to, it wasn't trained on that. It was trained with a cutoff being, where is the cutoff? Oof. So it doesn't see anything beyond July 14. It's July 16, 2014. Nothing. That's what out of sample means. It never saw any of this. And prices, they're not even there. Okay? So I just want to make that clear. That's why I deliberately show this with not up, it's not up to date on purpose. And what does it say? Lo and behold. You see that? So now I understand. Like it doesn't see data. It never saw anything after 2014. It literally runs out of data in 2023. And yet it's still predicting a high exactly when it landed. And this is a 7-year top. This is a 7-year top. So when is the low according to the 7-year top model? It's in 2028. More on that in a minute because I do think that the next big low from which gold breaks out is 2028. So we move on. 3.5-year cycle. This is the same cycle that shows up on Bitcoin, by the way. It's the same one. 1280. Same thing. Same thing. And this one was more, you can see that as we nail down, as we get shorter term, we're getting closer to the actual date of the top. So these models are working. They're working. And now it says February 14, 2026. Again, because it's a 3.5-year cycle, has a big margin of error. September 7, 2025, July 14, 24, 2026. That's what it's saying. Showing a top too. So 14-year cycle, showing a top. Overdue. The 7-year cycle, showing a top right around the time we got the top. The 3.5-year cycle is showing a top right around the time we got the top. And it doesn't end there. Now, what about the 21-month cycle? This is Perry on the lesson. This would be this is not the model I'm using. Hang on, let me switch. It's went advanced again. Should not go advanced mode. There we go. When did I switch this on? Anyways, maybe that was a bug. Anyways, this is the actual 21-month forecast. 21-month forecast. What is it showing? Same thing. Pretty big top. This is on a roughly 2-year cycle, and it's showing a top. Right around the same time, this one says January 12, 2026. It was off by a couple of weeks. And what is it? What is this one saying? Well, this one is saying, man, yeah, for this I actually would want to show you the let me see if I have it somewhere in here. Because I do want to show you the up-to-date for this particular cycle. Because I actually think that this October 17th, October 16th, 2026 low, I'm pretty sure that model is inverted. I think it's showing a high in October. But I could be wrong, and maybe the low is already in. But it's showing a top, suffice to say, and this is on a 21-month cycle. And not only that, and you can't really use the model this way, not really, but notice that it doesn't show significant moves, right? So I'm not saying, so these rallies, we don't know what they are. If we look at the chart, it seems to be suggesting that it's going to rally between, I don't know, 4,000 and 45 or 46. Can't really use it that way. But it is showing kind of a range bound period. And remember 2028, well, it does show a pretty big low August 2028. So a pretty big, sorry, this shows up as a high, probably going to be a low. Doesn't really matter. That's future. That's far away in the future. I think the closest thing we can say is December 2027. That seems to be when it's showing a breakout. It seems to be showing a flat. And again, this I don't know about. I'm not so confident of this as I am confident that gold has made a big top because it shows up in every multi-year cycle, including this one, 21 months. What this one seems to be saying is maybe it ranges for some time until late 2027. That's the most charitable interpretation. What does the yellow dotted line signify? This is the fitted cycle. Perry, when you get to the app, you can ask, what is the dotted line? Ask the orb. It will explain it better than me. It's just, it is the cycle. What I'm doing here is I'm taking every high and every low and fitting a sine wave through them. And I'm using that as one of the trainers for the models. There's 3 trainers in total. There's it uses filters, the same ones that I teach on the course. I also use a similar methodology, but using specific filters. It's like filters, but slightly different, like 2 versions of filters, let's just call it. And then I'm using fitted. Usually the models that are best for predicting are fitted. That's why I have this thing in here. It's just fitting the cycle. It's trying to get rid of the noise, basically. That's what it's trying to do. I got solid yellow, but don't know dotted yellow. Dotted yellow means it's an extrapolation. That's all it is. It's extrapolating. It's not really It's not based on price action. It's just projecting the latest fit to the present. And you're right. I should make that clear somewhere in the tutorial. I should draw that distinction. Good catch. Good catch. It's just when you fit a sine wave, the last few months, depending on the cycle, are blank. But you can project the same sine wave. You can project it to the present. That's what I'm doing here, which is why it's kind of a predictor, an early version of a predictor. And I left it in there because it's not terrible. It's not terrible. It is not used for forecasting. It's not used. The model is not trained on dotted lines because it's not real data. It's just an extrapolation. So because of that, it doesn't actually show that. Doesn't actually train on this. It's just I just want it up to date, and I thought, hey, wouldn't it be cool if we extrapolate it and sometimes that actually works? Sometimes it actually does work. Haven't tested it though. All right, so 21 month, and then we go to the shorter term cycle. Look, first, let's look at this. There's a great example of it working. Somehow, if I project forward the last fitted sine wave in gold's 160-day cycle, it nailed it up. It actually nailed it almost to the day. So sometimes I think it's useful to have. I don't know exactly what to do with it yet. I might do other things. I want to use this to predict or to suggest cycle inversions because they show up very cleanly with this dotted line. But because it's an extrapolation, I need to go back and see how exactly I build that. I don't remember. And whether or not it could be useful to detect inversions in real time. Because you need a clean wave to compare against another clean wave, which arguably the forecasts are very clean. Anyways, so what is a 160 saying? Same thing. I mean, you can't make this up. Every single cycle that is reliable because the 10 days noise says that in Q1 of 2026, there should be a high. And if you apply Hurst's framework with a forecast, which he never had, you have to conclude that what happened in Q1 of this year was a 14-year cycle top. And even if you dismiss that one because that one's not great, it's still a 7-year cycle. What are the chances that gold breaks out? Assuming we got a 7-year cycle top in Q1. What are the chances of a breakout in 26? 0. 27, almost 0. Maybe toward late 27, a rally could begin and we might get a breakout in 28. And that's what this is saying. This is why, and I know that's not what we were discussing this week. It was more about how sustainable this rally. I do think the rally could have legs and top out in October. And that's definitely a tradable rally. But is it going to break out? I don't think so. I mean, admittedly, I have not looked at other forecasting models as deeply as I have gold. But I will say I have not seen this type of alignment with other markets, with a caveat that I haven't actually looked at other markets that thoroughly. But this is remarkable. Like every single cycle forecast says Q1 2026 top, from the long-term stuff to the short-term stuff, all of them lining up. I don't think it's gonna be wrong. Of course, it could be wrong. It's a framework, but it's I would be shocked if this is not the top for some time. And by that I mean 1 or 2 years. I don't have silver here. Silver's the same. It won't change. Silver cycles are shared with gold cycles. And so if gold is doing this, silver's doing the same thing. I will add silver. I am creating I have a bunch of markets that I want to add. But before I do that, I'm creating an AI harness that will onboard markets for me. All I will give it is price time data and not even up to date price time data, just a slice of data and a ticker symbol. So I'm reserving copper, I'm reserving the Nikkei, silver, ETH, a bunch of assets I'm just saving so that the AI can onboard them into the app. So you're going to see them soon. However, gold cycles and silver cycles are pretty much lined up. It's like ETH and BTC. There are some differences. There is a possibility silver I don't trade silver. I didn't even look at it, but maybe it retests the Q1 top at some point, but it doesn't break out. I don't think gold will retest the Q1 top. I don't think there's any chance of that. It could. That is as high as the cycle framework would allow it to go, but no more than that. No more than that. So let me see if I have, while I show other stuff, I would like to show you the, oh, I have it here. I have it loaded here. Hang on. So almost sounds like it's most profitable to sell out of metals and convert over to cryptos. Well, metals are at the high end of the range, cryptos are at the low end of the range. That's how smart money thinks, Perry. That is how they think. And yes, I agree. I sold my gold leading into the high. I didn't buy recently because I'm not an active gold trader. I think, yes, buying 4K made a ton of sense as a trade, not as a, but if you know me, you know I like to capture trends. Not really, I'm not interested in gold going from 4,000 to 4,500. I don't care about that. I want to buy gold when it goes from 4,000 to 8,000. That's when I want to buy gold. And we're not there yet. We're just not there yet. From the framework, it looks like that's going to take a few years. Now, this is the up-to-date version of the app. And I want to show you this for a simple reason. Look at this. So this is the 160. This is the 160. I've seen this pattern quite a bit, guys. This inversion pattern. This is when I start delving into what causes inversions, this is where I'm going to start. You see these this high and then a low and then a high. Same thing we had in Bitcoin in Q1. And it caused an inversion. Well, back then, Bitcoin was inverted and this reverted the inversion. So when you have these back-to-back turning points, they sometimes invert. Sometimes what happens is they produce double tops or double bottoms and the model inverts. So this is definitely a pattern I've observed. I've seen this with oil a lot too. But look what it's saying. This is interesting. So already we know this is up to date now. It has yesterday's prices. Notice that the extrapolation was correct, right? So extrapolated that there will be a top sometime around here. It was correct. Now it's extrapolating a low, which I think is confirmed. I haven't checked. Pretty sure it's confirmed. But look what it's doing. Look how closely gold has been following this line. Look at the details. Look at these minor. These are minor, the level 2, level 1 turning points. That means they're minor. But they still produce something. They still worked. These were minor turning points. The fact that the yellow line is not turning at all means that these are not 160-day cycles. There are some shorter term cycles bleeding into the 160 forecast. But gold is definitely following even the smaller stuff, right? So it nailed the top. But then the forecast, it gave us more richness. This bleeding effect where we're seeing shorter term cycles in a forecast, I wanted to get rid of that as much as possible. But it turns out it's useful sometimes. And what's happening here is gold is actually resonating pretty well with these. And what it's saying is we were supposed to get this March low, and we got it, right? I mean, it's within 2 weeks. There is no range for level two's forecast there, but there's in reality a little bit of a range. And we got this bounce. Just make sure we get it clear. We got this bounce. It matches this. Then we got this stop. It matches this. Then we fast forward, and this is where it gets interesting. This is where it gets interesting. We have a 160 low here, June 29. Then we were supposed to get a top. Same pattern, same continuation pattern here. Instead, we get a low. So we get a low, but the next level 4 turning point is October or late September. And the model is inverted now. We know it's inverted. It inverted here on this turning point, on this level 3. So it inverted, meaning in all likelihood, this could be wrong. It could invert again. But if it doesn't invert again, gold will top out late September, early October. We go to the 21-month cycle, and we have the same turning point showing up as a low, but it's probably inverted. So this might be a continuation pattern. I want to make that point because I want to make another point. If this is an October top, not an October low, which the 160 is suggesting, then the next big low on the 21-month cycle is not now. It is in 2027 in June. And this is when I would expect the next big low in gold. It's June 27th. If it doesn't invert, that's bad news for us because it means the next low is December 27th. And these are the 2 dates that I'm watching. They're not this year. They're in a year from now. So I'm not watching gold, not trading gold. I mean, my vaults are trading gold, but I'm not because I think it's range bound. I think the evidence, the weight of evidence points to gold having made a 14-year cycle top, or at least a 7-year cycle. I think it's 7. I don't actually think it's 14 because fundamentals, right? I don't. If it's 14, gold needs to head back down to 2,500. I don't see that because I don't see that. I don't think it's 14 years. I think it's 7, and we're just gonna have to wait a couple of years. Then it breaks out. All right, oil and treasuries. Let me go back to local. Treasuries. I don't have such a robust view, but I'm watching this. Look at this model. This model is great. This is 16 months on treasuries. It looks to me like a low. It looks like treasuries are bottoming out. It looks like Scott Bessent is not done. I think he's gonna keep going. He does not want higher rates, and he's not gonna get higher rates. I have been watching this date around August, around mid-August, for months at this point, because this 16-month predictor, look at this. It's the only predictor on the treasury market that is green. That means it's the best model that I have for the treasury market. And it's bullish. And it only now turned bullish. And it nailed a stop in October 2025, which was remarkable because the Iran war briefly violated the view, but it realigned. It realigned and it kept going down. And actually, it's not the Iran war. The Iran war is the thing that caused the realignment. Apologies. Treasuries were rallying, and then the Iran war breaks out, and boom, it lines up with the forecast. Beautiful. The point is, it's a pretty decent forecast. It's pretty good. It has some inversions. Treasuries are tough, but this is a pretty good model. What are the chances that around the time of the expected turning point, and it's definitely a low, we can see that it topped out. The last turning point was a top. The next turning point, barring any inversions, should be a low. And we can see how treasuries are falling right into this date. And we're getting intervention talk. Right now, as the model says, as the planets say, hey, expect a rally in treasuries, we're getting intervention talk. That's good. I think that's validation. When would the trend shift? January 31st, so around February of 2027. So bullish for treasuries. That bullish treasury view could line up with gold getting a little weaker. Maybe. I'm not drawing that comparison yet, but it could be. It could be a sign of that. Those back-to-back red and green aspect energy seem like cracking the whip or price. Or like when satellites slingshot around a planet. Yeah, that's a good pattern. The back-to-back red and green. It shows a continuation pattern, but when it's not, it's an inversion pattern. So I think if I ever create an algorithm to detect inversions, I'm gonna see if it happens during these back-to-back turns. Because sometimes it's continuation, and sometimes a trend just flips, and it makes a double top or a double bottom, and the whole model flips. It's an interesting thing. This is new. Remember, I've only had this for like 6 months, so I'm still learning how to use it. Let's see, oil. Man, oil, I really don't know. I just don't even have an opinion. But let's look at it because I have to go soon anyways. So what do we have here? An inverted model. That's the first thing that jumps at me. The 4-year cycle is definitely inverted. Bottom right to the day. Almost right to the day, December 2025. And we have a top also when it was supposed to produce a low. So it's inverted. That's good news for us because it means there's a high coming in December. So maybe still more nonsense about this war. I would say that there's some alignment here, apparently, like in this October. Apparently, October looks like a turning point. We have December. We had December for treasuries, right? It was December for treasuries, right? These two are definitely. Oh no, it was February. It's January 2027. Does it bleed into December? It goes into December. So maybe these two are inversely correlated. I don't know. I don't have a strong opinion on, oil, unfortunately. Let's look at other models. Let's see. This one's probably the best to look at. Oh, okay. This is much better. Uh, Oil is such a. You see the same turning point here. You see the same rally here. It kind of nailed this high. It looks like it's heading into a low. March 27. But if we look at the 4-year cycle, we look at the 4-year cycle and it looks like. Actually, you know what? This is. No, this is. This. Okay. All right. All right. It changed my mind. So this is a 4-year cycle picked up. There's a double bottom here. The 4-year cycle forecast picked up on the first one of the double bottoms at 58. They call it 60, March 2025. Then it predicted a high to take place soon. For that, we needed a rally. We got the rally. And now it's saying that oil is generally heading lower. The problem with oil, the reason I hate it, is super manipulated. So you have these whipsaw moves that don't show up anywhere. So imagine what we had in Bitcoin over the past 3 days. That happens every other week in oil. It's so manipulated. But you can see that I don't know what to make of this yet. I'll be honest. I think it's showing that this is a double bottom. We're going to look at the shorter term cycles in a minute. But it looks like the 4-year cycle, ideally the low would have landed in April 25, and it predicted a high, which we did get around this time. And oil is heading lower. I do think that everything, all these headlines in Iran and everything, from looking at my models, I've developed the view that it's probably not going to escalate. It's probably not going to get terribly horrible. Um, just looking at treasuries and oil, it looks like oil will weaken and treasuries will firm up. And that means this Iran thing, something has to happen. So it looks like it's showing normalcy. There were other markets that I had, other forecasts, other versions of forecasts that I had for oil, and they were showing. So this one's inverted. This model is inverted. That's great. It's showing a high. It's actually a low. But it shows November as a minor turning point. It might, it might produce a low here. Clearly inverted this one, so I don't like that. I would focus on just these two. And I think we have some alignment there where a low, call it February 27, and this one shows, assuming no inversions, it's yes, February 27. So same low. Uh, Looks like it stopped out. It does look like it stopped out. Um, Now we'll look at the 240. Now again, this is a yellow model. Yellow means not so good. What it actually means is it has a lot of inversions. It's not that the model is bad, it's that it inverts frequently. That's what it means, in my experience. The 20% correlation, that's not true. It's actually stronger than that. If you take inversions into account, I just don't know how to do it. Not yet. So you can see how if you look at this model, it does actually have important turning points, right? I mean, it has this one in March. Well, this one looks minor, but it inverted here on April 7, where it produced the top. The actual top, there is an actual high on March 10, which shows up in the forecast. It doesn't show up in the price. Sorry, I switched screens briefly. But yeah, there is an exact top. The actual top in this rally is March 9. But because my framework is using closest only, it doesn't really show up. But look at the forecast. It's March. It says H3. It's March 10. So these two, it's the same pattern, right? The back to back green and red, and it produced double tops, and it flipped the model, and it nailed this bottom too. This is almost to the day. So I give it a wide margin of error, but the actual low is July 2, projected for July 13. So this short-term model is not as bad as the numbers suggest, and it's showing, well, look at this. It's showing a low in January 2027. The other two said February. They're lining up. What's probably going to happen is we're going to have another inversion. So this will probably be a high on October 17. It will produce oh wait, so no, that's not correct. We needed to re-invert. So I don't know I don't know what's gonna happen. Doing this in real time. But it is what I'm trying to say is it is working if you drill down into the dates. Oil is a spicy one. It's just hard to predict. Um, but I think it's doing a decent job, this 240, much more than the numbers would suggest. And we do have a low in Q1 next year. We do. So it looks like, based on this, I would say, well, here's what I think was going to happen. We're going to get another low here in October. We're going to get a high in November, and we're going to head straight down into a low in February. This is what I'm seeing, because the 480 day, the 16-month cycle, and the 3.9 year, they agree. We have already topped out. We're heading lower into February. The 240 is the one showing all this volatility, but it's volatility within a downtrend. That's what it's really showing. So I do think it's um this model is currently inverted. It will de-invert at some point. Don't know when, but it probably will. And then we're probably gonna realign with the other two. And you already know if it's rallying into Q1 of next year, that's the top. And it was the other models that were inverted, and this one was telling the truth. Now, this model, because it's yellow and it inverts a lot, I'm willing to bet that the 4-year cycle forecast, the 16-month forecast are correct in their outlook that actually oil topped out in Q1. All we've had since is volatility. And this is not a political commentary on the sanity of the war, because it's absolutely fucking crazy that it happened and that we're in this situation. But it looks to me that it's not going to escalate, and it's actually de-escalating before our eyes. And what we're getting is just a ton of just volatility. But that volatility is trending lower, which is good for us because Bitcoin is not going to do great if oil is at 150K, $150, and the treasuries are crashing. We need firm treasury market. We need a soft oil market, and I think we're getting it. And remember, these are blind forecasts. They don't have an opinion, right? They don't want this algorithm does not want oil to go down or treasuries to go up or Bitcoin to do great. These are blind forecasts. But I do think, and I think you would agree, all of you, that yeah, the forecast for oil is not really saying, oh my God, it's gonna go to 150. And by the way, um, I tried several versions of these forecasting algos. I settled on a single version because I realized there's actually no right way to do this. You just have to pick a methodology and just stick with it. Because I tried, like, I don't know, 7 different combinations, lunar nodes, using asteroids, using midpoints and midpoints to midpoints and whatever. And it all produced pretty much the same stuff. So I settled on a simple methodology, just a solar system and top 80 features, done. So what I'm trying to say is you might remember different versions of these oil forecasts. They all said that Q1 26 was the top. And I ran this. Let's see when I ran it. I ran it with my data ended on May 2026, so it never saw any of what happened next, and it still said oil was gonna soften, and it was correct. So yeah, need to know the trigger for income and inversion. I don't have that yet. All right, so Perry, I'm gonna read your comments and just gonna wrap here because I do have a hard stop and I'm already late. How does the Treasury forecast line up with actual interest rates? It's the opposite. It is the opposite. I no longer forecast interest rates though. They're not great. So I stopped doing that. I just went with treasuries. They don't disagree though. They do not disagree. The cost of cheap money, the risk on, risk off for all assets. So in this context, Barry, I believe that if treasuries do well, it's not because we're in a crisis. It's because things are normalizing and calming down. Why? Because we have high interest rates, because we have a high oil market. If the Iran situation, the geopolitical tensions ease, what you're going to see is you're going to have lower interest rates because people are going to start pricing in lower interest by the Fed or whatever. So you're going to have lower interest rates. You're going to have stronger treasury market, and you're going to have a softer oil market, and it's risk on. It's definitely risk on. Actually, the whole inverse correlation between risk assets and treasuries, it doesn't actually hold up. It doesn't even hold up. It's not true. lower interest rates are bullish for risk assets. It's not, you know how people treat it as the opposite thing? It's not really. Stock market and it's interest rates that are inversely correlated. Interest rates come down, risk assets go up, but the correlation with bonds themselves is positive. So in this case, because the treasury market looks like it's about to blow up, if the treasury market comes down and rallies into Q1 of next year, that's bullish for crypto, it's bullish for stocks, it's bearish for oil, but I don't think it's treasuries causing oil to sell off. I think it's the opposite. I think oil selling off will prove to be bullish for treasuries and most risk assets. All right. It seems that I need to know. Oh, wait. So Perry's saying it seems then I need to know the macro trigger when to switch following JPM2, bonds, news, etc. Maybe there is a reliable timing that switcheroo. How I do it? How I do it is, and I'm gonna wrap with this. And I didn't used to do it this way. I used to want to have one indicator and forget about all the other indicators. Unfortunately, I'm not there. I landed on the opposite. I have this. So, you know, my Bitcoin chart is always showing me, come on, do I have it off? Okay, there we go. So my Bitcoin chart is always showing me Japanese M2, the favorite, the most statistically sound. But if I switch to this second tab, I have Bitcoin against central bank liquidity, T-bills, and bonds. So I just look at them. I look at them all the time. And the reason I'm doing that is because I made that mistake of not looking at one of these, Japanese M2, for Q1 of this year, which predicted a sideways market between February and early April. That was a costly mistake for me because I loaded up on Bitcoin way too early. And I realized, hey, I knew that Japanese M2 is good. Why did I not look at it? Why did I choose to forget this valuable piece of information that would have said a lot about what to expect because I already had the position, but I thought something was broken. I thought macro didn't matter anymore. And it was just that it was following Japanese M2, just a totally normal explanation. Um, so then I realized I have to look at all of them. You just have to look at all of them. I guess, I mean, market analysis is just not that simple. I wish it was. It's like inversions with the forecast. Like, I wish it was predictable. It doesn't seem to be predictable. It just happens. And you have to deal with it. And this is the same thing. I never thought for a second that bonds don't matter anymore. I was just aware that prices are not really following bonds. Just like CBL, central bank liquidity, I don't talk about it so much nowadays because it doesn't seem to matter. But it will matter at some point. There's gonna come a time when there's gonna be a move, and the move will be clearly highlighted by central bank liquidity and maybe not necessarily in Japanese M2. So you have to keep all of these in mind, juggle with all of these, and try to come up with a consolidated view that takes everything into account. Sometimes everything lines up. For instance, the February low for Bitcoin, everything lined up. Japanese M2, central bank liquidity, bonds, T-bill issuance, everything lined up. So it was a good forecast. The top in October, we also got it. It was a little early for CBL, but we got it. We got this top in October. Everything lined up. Now, no, it's not. And that's how it is. It's not wrong. It's not broken. It's just reality. It's just not that simple. It's just not that simple. And I've been doing this long enough to know that I don't expect it to be simple anymore. It's complicated. And sometimes it's easy. If you have a good framework, it works most of the time. It fails. This guy that I talk to every once in a while, Cameron, great guy, and he said something that bothered me when he said it, but he's right. He says, it's a quote from some statistician. I've said it before. All models are wrong. Some are useful. That's all this is. These planetary models are wrong. These macro models are wrong, but they're useful. They're very useful because they often show us what's going to happen. And that's all we needed them to do. Usually they show us what's going to happen. Not every time. And that's all there's to it. All right, so I'm gonna get to those two, Perry, and then I'm gonna bounce. U.S. has midterms at the end of the year too. I know, and the political agendas have been known to distort markets. Not what we're seeing in Bitcoin. That's not what we're seeing in Bitcoin. That's much more short term. This is a short squeeze. This is not what we're seeing. The map is not the territory," said Alfred Korzybski, 1934. Exactly right. That's a great quote. The map is not the territory. It's just a map. It is just a map. You're going to encounter things when you're there that you didn't really see in the map. That's what you're seeing here. You don't really see this. We're not really seeing this surge. But because this is a reality of markets, this is why I trade with algorithms. Because I know my algorithm is designed to capture volatility. It will never miss a move like this. It will never miss it. So why do I trade with an algo and not on my opinion? This is the reason. I just had a great 3 days. I had no idea it would happen. It's just a scalping wall with an algorithm. That's why I prefer that methodology. Maybe the model should have meta model that tracks the change in correlations of each indicator, JPM2, bonds, and notifies what's improving and worsening. I have that actually, Barry. But it's backwards looking and it doesn't actually, it's not great. It's not great. But I'll design something along these lines. I will have this at some point, something that flags inversions or flags when the correlation is changing and favoring one versus the other. I will have this at some point. But what I tried initially was like it didn't really stick. It's just it wouldn't really work. It highlighted. Sometimes it worked, sometimes it did. And I want something that is, reliable. That is, if it's going to highlight switch to bonds, I should really switch to bonds. It shouldn't be something that maybe you should switch to bonds, but when I look at it, I go, no, 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 you're wrong. All right, guys, I have to go. I have to fix some trading algorithms after I pick up my daughter. Actually, that's why I have to run. Um, Thanks for joining. This was an awesome session. It was fantastic as always. I'm glad you liked it. If you're watching the replay, I hope you can make it live next time. We have some viewers from Australia. I might accommodate Asia at some point. I do want to do that. We have a lot more people now, so I also have in mind to do these weekly and just run them for an hour. Not yet, but I think it will be much more fun to do these weekly because I also want the YouTube content to be more up to date. Sometimes it gets a little stale toward the end. So I'm trying to, I'm working on that, guys. I'm working. I got a lot going on. That's all. And as you know, trading algorithms are my priority right now and they're broken. So I got to go fix those. All right, everybody. I'll see you on the Discord. I'll see you in the next one. And if you're watching the replay, thanks for sticking with it this long. I really, really, really appreciate it. A lot of you actually watched the whole thing, which is amazing. So thanks for everybody, guys. Thanks for everything.